one thing led to another. Here we are, 6 years later.
I stalked him like a puma stalks a prey in the Amazon rainforest for like 3 months, and then eventually he was struggling enough with content where he was ready to also listen to advice and not just be my friend. And
You're
then I
just gonna do
think,
it yourself, right?
yeah,
Yes.
Yeah.
yeah.
Yes. Those were some dark days for the internet and for me.
All right, y'all ready?
Yep.
Cool. GC, I'm gonna just run through the roll call since it's remote, right?
Gotcha,
Cool.
baby.
Got it. All right, let's go. Welcome, everybody, to a very special edition of the Not Your Average Investor Show. You may or may not have heard, but there has been a whole bunch of big, beautiful bill tax talk, and everybody's wondering what it means, what's permanent, what's temporary, what's important for an investor, what's just cocktail talk, what is overpromising. We're going to go through all of that with our resident CPA tax expert coming back on the show. I'm your host, Pablo Gonzalez. With me, as always, the man that I affectionately like to call GC because he's got the genius concepts, knows how to generate cash flows, is a great co-host, and because his name is Greg Cohen. Say hello, Greg.
Hello, everybody. Fantastic to be with you today.
And back on the show today, back by popular demand and a little bit of like begging and pleading from Greg and I because he's a great guest. He's part of Pivot CPAs from the glorious land of Gainesville, Florida. Bryan Reyes, welcome to the show. Welcome back, my friend.
Thanks for having me, guys.
Good to have you, man. Good to have you in studio.
Just a few Gators hanging out. Are we going to talk Gator sports for the next hour? Is that what we're going to do?
We're going to do here?
I think so.
I think there's happier things to talk about. All right, guys. And Bryan, I know that you've been on the show before. You know how we started. Do you know what it's called, this little tradition that we start with?
I don't, because I think last time, I had to do the tape recording.
Oh, yeah. This is your first time in the studio ready to rock.
All right, GC, you want to help him out with what this is
The
called?
roll call, baby.
Roll call, baby. We got our leadoff. Oh, sorry. No, we got the MVP kicking us off today. Mr. Lee Bishop. We got our leadoff hitter batting second. John Heading. We got the ringmaster in the house batting third. Andrew Barnhill. We got El Gran Amigo. Buenas tardes desde Duval. Billy Shields. Good to have you back. Jeff Pettijohn from Missouri. Mark Sauer from Cincinnati, Ohio. Good to have you back. We got the Mountain Mouner saying good morning from the soon-to-be snowy mountains of Colorado. We got Le Monsieur, Reyes Français from the Inland Empire. Good to have you, Reggie. We got the Mavens from the mountains of Denver, Leslie Wilson in the house, HTTN, Hannah, and I'm struggling. We're halfway there. We're halfway there on the HT deal. We got Ihab Eskander is back. Ihab, we haven't seen you in a while. Good to have you back. Lita Song, beautiful investor from Minnesota. Good to have you. The early bird in the house, Mr. Dean Curry. We got Il Maestro from New York, Long Island, the world famous composer John Williams. We got the KOB, King of the Beach, Christopher Lee. Fernandina Beach checking in. Laura Colby from Washington State. Good to have you back, Laura. Well, this is a good one. This is a really good roll call. We got the Shaman. Nadeem Shah with his trademark good morning, good afternoon from the Pacific Northwest. Who else we got here? Mark Norman is back in the house. Good to have you, Mark. Rich Sika from Jax, Misty and Troy Johnson, the top 10, world famous top 10 attendees from the Colorado area. The matriarch of the first family is in the house, Carolyn Moline, hoping that Ken is also with us today. But we salute you, right? The first family house, Ken and Carolyn Moline. Hope that Ken is on a happy speed to recovery here. And Pamela Myers, favorite smile from the Seattle area. The Hall of Fame first baseman, Jim Kirko from San Diego. Good to have you in here. This is a good roll, man. Bryan, I feel like you bring up people want more Bryan Reyes is what I'm hearing in this roll call, man. How does that feel?
There's only one. There's only one.
That's only one. There's only one. And before we get going, we got some big breaking news that we broke at the end of last show. It's time to lead the show with it, GC. Lead us in this breaking news.
We do. The most talked about thing in the entire world is when is Summit going to happen next year? Next year is Not Your Average Investor Summit. We have the dates for you. A little save the date action for you right now. February 19th. To February 21st, 2026. That will be the next Not Your Average Investor Summit. And if you have been to the if you know. If you have been to the summit, you are absolutely going to want to reserve your time. and reserve those dates so that you can spend some more time with us. And if you haven't been to Summit yet, we would love to have you. It's our annual conference for our JWB clients to connect, to get to meet the team, to get to see friends you haven't seen in a while, and to learn more about rental property investing and what's going on in downtown Jacksonville. So we are pumped.
We are pumped. There's always some surprise and delight that happens at the summit. There's always some education. There's always some behind the scenes of what's going on in Jacksonville. But that's all you need to know right now. What are the dates, GC?
February 19th to the 21st.
February 19th to the 21st. Plan on being in Jacksonville, maybe starting February 18th, maybe leaving the 22nd.
Yes.
But now, you know, as your travel plans are happening, this is the dates that you got to cordon off if you want to be here. We limit it to 100 people. Of course, the Not Your Average Investor family will be the first people to get access to coming. Got to be a client. Can't wait to see you there, February 19th to the 21st. Circle it on your calendar, and let's talk taxes, baby. Bryan, we had a onboarding call. I mean, so little backstory on your history on the show. You were the type of person that loves to print out the new tax code, curl up next to the bonfire, pour yourself a nice glass of wine, and just like read through that thing. Is that the truth? Is it a wine thing?
I mean, bourbon. Better than wine.
Yeah.
But you got me, man. I mean, that's what I do for a living. I'm a CPA. So yeah, I mean, I read this stuff. You have to if you're going to be any good. So
the only guy in the world probably that likes learning about tax savings more than me is the guy right here.
Yeah. Greg is famous for his like gusto about taxes, but Bryan is Greg's tax guy. This is the guy that you go to for that type of love. So Bryan, so we had this onboarding call. We talked about this idea that there's some like real cool like cocktail conversation stuff, but there's also things that investors really, really need to know about. You broke it down for us into permanent, temporary, and just like interesting topics. So I'm going to start with the permanent stuff that you talked about in the Big Beautiful Bill. You talked about this idea about 100% bonus depreciation. You talked about the qualified small business deduction, normally known as QBI, and R&D expensing. The way that I understand it, this bonus depreciation thing is kind of like the most relevant thing for rental property investors. Can you give us a little what are the provisions around bonus depreciation? Like explain the bonus depreciation and then what's new.
yeah, so bonus depreciation is a law and a topic that, God, now for practicing for over 20 years has been around. There's varying levels of bonus depreciation, but what it means is it allows you to take a higher than normal depreciation in a given year. So for rental property, that's good, right? You're reducing your tax liability and your taxable income by depreciation. Sometimes it's 30% bonus depreciation. Sometimes it's 50% bonus depreciation. Sometimes it's 80%. Well, with this new tax bill, we now have this permanency of 100% bonus depreciation. The property has to be qualified property. So if you buy a building, the actual building itself is not going to qualify for bonus depreciation. A lot of the components are furniture, fixtures. One that we see a lot of people miss on is land improvements, irrigation, parking lots. Those generally qualify for bonus depreciation. So that's one that we do see commonly missed. That's low-hanging fruit. So if you have an asset or if you construct an asset and there are items that qualify for this bonus depreciation. So if you have a rental property, $200,000 purchase price, and you have $20,000 worth of eligible property, you take $20,000 of depreciation in 2025, and then you take your standard regular depreciation on everything else. And so I think it's a great thing. We're advising our clients right now. We've been taking calls, and trying to work through and get things organized for year end. So
Greg, right size this for us, right? Like, what does this mean for the Not Your Average Investor from your perspective?
Well, so going into rental property investing, one of the things that we love is just how easy and accessible these tax savings are. Just what we call the standard tax savings. You don't have to be a certain type of professional. You don't have to make a certain amount of money. You have these wonderful built-in tax savings components of rental property investing, largely depreciation. And depreciation is wonderful because even though you might not spend the money in that year, you get to write off the depreciation of the building in that year. Well, what bonus depreciation allows you to do is to basically do that kind of standard depreciation deduction and put it on steroids. Because, that standard depreciation deduction is typically over 27 and a half years. Now, you can look at certain parts of the house that might break down faster in the eyes of the IRS. And instead of that being over 27 and a half years, you might be able to write all of that off this year. And so what it allows you to do is to supercharge your tax savings, and it's available on rental properties, it's available on some other things as well. But you're starting to see the things that this applies to really start to generate a lot of demand. I remember when bonus depreciation first came out back when, I don't know when it was, 6 years ago, I feel like I started to hear it, right?
Yeah, at least. Yeah.
And I remember that there were tons of planes that were being bought. And it was because you could write off the entire plane, private plane, in the first year. And so people were looking at very wealthy people were saying, I'm going to go buy a plane. And it was because tax savings was driving that demand. Here, you're not able to write off the entire building, right? It's just components of it. But when you work with a qualified tax professional to help you understand which components can be accelerated, it can save you thousands of dollars in real tax savings, specifically because of this bonus depreciation, which is on top of the standard depreciation benefit that we get as a rental property investor.
Got it. So if I am thinking about this from the lens of our typical community member, right? Like, I think that there is kind of like two sides of this depreciation conversation in general. One is the idea that if you are an active real estate professional, you can take this depreciation against your active income. Many of us in the Not Your Average Investor Show community, we choose to invest in JWB because we are passive investors, right? We are not active real estate folks. For the active real estate investors, this is obviously like a really big thing, because you can deduct this against all of your income. For the passive investor, talk to me about what I'm hearing is we used to be able to do a certain level of depreciation. Now there's extra depreciation that we can take out. How do I think about this when it comes to like my passive income and this like extra level of bonus depreciation? How do I right size the expectation of like this type of break?
Well, I think it might be important to talk through the three buckets of income, right? There's three buckets of income. So you have active income, and this is on any tax return. You have active income, which is wages, businesses that you are active in, or if you're an active real estate professional. So that's one bucket. The second bucket is investment income. So that's interest, dividends, capital gains. And then the third bucket is passive. So generally rents, net rental income is passive. But if you invest in a Moe's franchise, right, that could be passive. And so those three buckets have pretty big barriers amongst them. If you have losses from one bucket, they don't jump across, right? You don't lose them. So if you have a passive loss in any given year, it's not like it's up in smoke. It just goes into the next year, right? So when we're sitting down talking to our clients, there's a lot of good stuff here, but we make sure that we're in these right buckets. If somebody says, hey, I'm thinking about selling this business, or I'm thinking about selling this piece of real estate, how does that impact my overall tax picture? Well, I don't know. Let's look at where these buckets fall, right? And so sometimes I think there can be an expectation gap of the perception of what could be out there versus the reality. 100% bonus depreciation is an unbelievable tax planning tool for all of our clients, every single client we have. But the expectation and when you take that, I think, is very important. But keep in mind, you don't lose it. So if you had excess bonus depreciation, you're just carrying it over into the next year. And you might have, let's say you have a portfolio, and we see this. Say you have a portfolio of 50 properties and you haven't bought some new ones in a couple of years. Well, those 50 properties are probably spitting out some really nice taxable income.
Yeah.
Well, sometimes you can layer in some new properties to reduce that passive income.
Yeah.
You know, so I think sometimes people forget about that. It's like,
Yep.
if you have older rental properties, this depreciation can offset those older rental properties because they
100%.
group that. So
People, I get this question. I get two main questions all the time. Well, if I don't use the depreciation in my rental property today, do I lose it? And like Brian's saying, no, it's going to be there next year or whenever you need it, so you don't lose it. So that's a really important point. And the other question we get all the time is, can this write off against my active income? Can my rental property losses, with losses when I say depreciation is what is the tax loss we're talking about here, can that offset my active income gains? Do you want to walk people through that, since that's a question we get all the time?
yeah, it is. And generally the passive rental losses don't offset. So if you have, let's say you have an accountant, let's say an accountant has wages, they have their active income, and then I go buy 6 rental properties and my net rental loss is $60,000.
Mhm.
If I have a $100,000 W-2, that 60,000 is not offsetting.
Doesn't offset.
But one thing we do, and I don't want to go too far down the rabbit, sometimes we plan with spouses, right? If the taxpayer is a CPA, well, maybe the spouse could go get a real estate license.
Right.
Maybe they have the time, because it has to be one of the two, right? So that's a little tax plan. I didn't mention that earlier, but that's something we do sometimes with spouses, to say, well, this spouse could. Now, to do that, you want to make sure you have the proper fact patterns, that they can spend the amount of time, they understand how to draw up leases, and working with a property management company. But we do see that from time to time.
Yep.
So,
Absolutely. So if you have the ability to qualify as an active real estate professional, there are certain things that you have to do. You can take what we call as just kind of like the standard way of going about tax savings in rental properties, meaning just getting your passive losses from depreciation. And you may be able to write them off against your active, but you have to be a qualified real estate professional. So, and if that happens, then everything we're saying is just even more awesome, right? It's awesome as a standard. It's just a little bit more awesome if you're an active investor.
well, I would say
active
too,
real estate professional.
some questions are, should we even take bonus depreciation? You know,
Yeah.
if it's going to just create a $60,000 loss, should we take it? Well, absolutely, because otherwise you're depreciating that over 27 and a half years. So if you don't take it, you can't. I mean, you can. We'll get into it in a minute. You can go do a cost segregation study, but to do it retroactive is much more difficult. There's more exposure on your tax return. Nobody wants to be audited. So trying to put it in the proper year, and when bonus depreciation is 100% like it is now, you absolutely, with 100% certainty, want to take the bonus depreciation.
So I want to walk down that path. Meaning we understand bonus depreciation is something that you should do if you can take it, right? There's no reason to not do it, but you have to do certain things in order to understand what bonus depreciation is in your specific situation. That costs time and money, right? You have to hire professionals, and a cost segregation study is a question we get a lot. Can you give your thoughts on what a cost segregation study is? What's necessary for the average investor to take advantage of bonus depreciation?
Yeah, good question. So first, I think there is some thoughts that you have to have a cost segregation study to take bonus depreciation. That's not correct, right? Because to your plane example, the whole plane qualifies for bonus depreciation. You don't have to go segregate that. The cost segregation study takes a building and it segregates the different components of that building. If you go buy a truck, right, the whole truck qualifies. So there's nothing that says you have to have a cost segregation study to take bonus depreciation, first and foremost. So some of our clients, some of the clients we share, you know, we get the construction data and we see, okay, well, we're not going to hire an external firm to do a cost segregation study, but we can spend a few hours with our clients and componentize stuff, have a conversation with them. Well, here's the landscaping. Did you put any furniture in? Oh yeah, I put 5,000, you know, and so you can spend a minimal amount of time and get pretty nice answers, right? So then the question is, what is a cost segregation study and who does them? So there are a lot of cost segregation firms out there. And I would say, like anything in a free market, is not all cost segregation studies are created equal. You know, there's some that are, you know, very low cost, and nothing against those. Just be very careful, you know, because a good cost segregation group should provide audit protection. because they're going through and doing the calculations. If they've not been around a long time, be very wary of that, because anybody can set up a cost segregation, just go set up an LLC and start doing cost segregation studies, right?
So I'm hearing a lot of chatter about cost segregation
Yeah.
studies that are offered for like $1,000. You know,
Yeah.
I hadn't heard that prior to maybe like last year. I hadn't heard that. I had heard that they were way more expensive than that.
Yeah.
But I feel like there's a lot now that
Yeah.
are extremely cheap. So you've seen the downside
Oh,
of
yeah.
using a cheap cost segregation
Yeah.
study, right?
Yeah. So we had a client that, so we work with a vendor, McGuire Sponsor, you've probably heard of them.
Mhm.
And so they're out of the Midwest and they do a really good job. They provide audit protection. And so we get a free analysis. Client can send us some data. We send it to them, and then the McGuire Sponsor will say, this is what we think the fees are going to be, and this is what we think the tax savings is going to be. So then we take that, sit down with the client, and then if they want to engage, they can. Well, this client had also went to a different cost segregation study. And let's say this was a big commercial project. So let's say McGuire Sponsor's fee was like 10 grand, right? Well, this one was like 3 grand. I'm like, well, send it over to me.
Yeah.
And so I sent it to McGuire Sponsor because I was just like, man, this is like, what's going on? He's like, well, we generally will try to meet fees. And if it's within a couple grand, they would. But what this firm had done is they didn't provide audit protection. So if this client gets audited and this is an unreasonable cost segregation study, they're on their own, completely on their own.
Yeah.
And then they had tweaked the land basis to reduce the land basis down to a very small amount, instead of say 700,000 that was on the county records to like 200. So now you have all this other eligible property. It was just not supportable in the IRS, because a lot of what we do sometimes too is think through, okay, how is the IRS going to view this, and communicate that with our clients. So yeah, every cost segregation study is not created equally. There's a ton of good groups out there. I mean, the first thing is just how long they've been around, right? What are you going to do? How are you going to help me if I get audited?
Yeah.
And if that's not an easy kind of organic conversation, go find somewhere else and get a couple quotes.
Gotcha. Gotcha. Okay. And that's really good to know that you don't have to do a cost seg study to take advantage of bonus depreciation. I'm still a little bit unclear of like, if I'm one of our JWB clients, or a not your average investor, I've got 3 rental properties here. I want to take advantage of bonus depreciation. I want to see how much I can take advantage of without spending the money on a cost seg study. What do you do? Is it just that you just keep the receipts on what, you ask JWB for what did they spend on landscaping and send it to your CPA, or what do you do?
Yeah, it's a good question. I mean, it is that easy.
Okay.
Yeah, I mean, you could say, okay, let's say you bought a house that was just constructed, right? And you say, okay, well, if you do nothing, it's 27.5 years, right? Well, you could just have a couple questions, right? And say, okay, well, can you provide a little bit more information on what you did? Landscaping, super easy. Driveways, that is low hanging fruit. That is a no brainer, that you don't have to spend 10 hours to go through and do all these spreadsheets. Most times it's just right there on the contract. It'll kind of outline, the different allowances for stuff. And then when if you're preparing your own return, you just go in, and I've be frank, I've never used TurboTax or whatever, but you just go in and you probably just put the land basis, the 27.5 year property, and then the eligible property for bonus depreciation. But if you're working with a CPA, they can just go in and key that data in, and they would just need something to support that, whether it's an invoice, really an email, hey, I spent this, or I talked to JWB and they broke it out this way. It's not rocket science, but you just have to spend a little extra time. This is a good time to do it too. Go ahead and start organizing your files. So when you send it to your CPA in March, it's not delaying the process. Talk to your CPA, say, hey, I bought these 4 properties. What are you going to need? Spend the time now to get your house in order versus later.
There's the reason why we're able to get Bryan here now in November. He's unavailable any other time around April to October. But I think this is good because, for a turnkey rental property, you're going to make a couple $100 a month in cash flow, that positive cash flow. But just by your standard deduction, you're going to show a tax loss. That's a beautiful thing, right? So for most of us who are just buying properties or in your first few years, your depreciation, the standard depreciation, is going to offset the positive cash flow. And that's a beautiful thing. So it's not like, spending the money on a cost seg study makes a ton of sense unless you have a significant amount of rental income coming in each year. You really want to look at what does it cost to do the study, and then how much tax savings am I going to generate from that in that year? Well, if you're making $200-300 a month in positive cash flow, that's awesome. But that's already going to be offset even if you don't do bonus depreciation.
Yep.
So it's really good to know that you can still take advantage of bonus depreciation. You just have to ask for receipts or some of the costs. And JWB would be happy to help you out with that on properties that you purchase from us. Let's take it to another level, though, because I think this bonus depreciation thing is something that it is pretty exciting, and it really, really can save a ton of money in certain examples and situations for rental property investors. I'm thinking if I own if I own a ton of properties, or if I own some properties that I have experienced a big gain on, and I sell that property in that year, walk me through that example and why it might make sense to spend some good money on a cost seg study in order to make that a good return on that investment. How would that work?
Yeah. Yeah. So if you sold a rental portfolio, or let's say you sold a business, let's say you had some Moe's, I'm giving Moe's plug.
You love Moe's.
I don't know where that came from. But just whatever restaurant, and so you sell that in 2025 and you have a significant gain. And let's say it's passive. Let's just keep it all in this passive bucket. Let's say you have a bunch of different businesses. And so if you were to buy some rental properties between now and year end, or if you've already bought them in 2025, because this date, any asset placed in service after January the 19th of 2025 is eligible for the 100% bonus depreciation. You could have that depreciation offset that other passive gain, right?
Yeah.
And so it does make sense to look at, one thing we do with our clients too is some clients will ask, should I buy a truck, or should I buy this rental property? I mean, the first thing is, does it make sense from an investment standpoint? Right. I never advise clients to go buy vehicles or whatever to save taxes. Does it make sense from an investment standpoint? Then it's, when would you want to place it in service? When's the best time to do it? If you knew, well, my tax bracket is going to be the highest it's ever been in 2025 because I'm selling a business, or I'm selling some real estate, and I'm in the 37% tax bracket. And then let's say in 2026, you're going to kind of fall back into the 24. It makes sense to do as much of that as you can before you're in, because you'd get it at 37 cents on the dollar versus maybe 24 cents on the dollar next year.
Yep.
So
100%.
So timing can be, while generally depreciation is temporary, timing of it, sometimes you can make it a permanent write-off.
Yeah, because tax planning and tax savings is all about when you have a huge income event, let's make sure that we have huge deductions that we're able to take that timing that year. So let me just run the scenario. Let's say that I had a business, a Moe's, that I sold in 2025 and I made 250 grand. I had a gain of 250 grand on that. And then I bought 5 rental properties in 2025. And I spent, I don't know, 10 grand on a cost seg study for all 5 of those properties. And I was able to write off $50,000 of additional bonus depreciation on each one of those properties. Yep. By using bonus depreciation as your friend here, you could take that $250,000 of bonus depreciation and offset the $250,000 gain that you had from Moe's, right?
You got it.
Okay. So when bonus depreciation really, really can be powerful is if you have a big gain happening. You know that you sold something and you have a big gain. Then it might really make sense to spend some money, get some audit protection with the cost seg study, and then you save a ton of tax dollars. That's really the power of it, right?
Yeah, absolutely. Yeah, no doubt about it.
Man, that's awesome. Pops,
that was a great summary, GC. No, that was great.
You were here, man.
I wish I was there too, but you guys were just jamming on it. I just wanted the focus there. I love it. And kind of like we said, this was going to take up about half the show for sure, right? And we're right there. So like now that we're halfway into the show, I want to ask a couple of questions with this, and then I want to move on to the next stuff. But I just want to also say that if you are looking to add a rental property this year, you may have a big passive gain that's happening. You want to offset that. Go to chatwithjwb.com, or the phone numbers are, GC, help me out here. What's the phone numbers? 904-677-6777.
Nailed it.
I'm getting better at this. I can't remember the text number.
904-293-0341.
There you go. So go to chatwithjwb.com, set up a time to add a property to your portfolio if you want to take advantage of this stuff. Real quick, as far as adding properties at the end of the year, before we go into questions about bonus depreciation and stuff, what are the benefits of that? I heard you guys kind of like talking about this as we were getting ready for the show. What should I be thinking about as far as like adding a property before the end of the year? What's the benefit to that as opposed to say Q1 of January 2026?
Well, I think again, it all depends. As we started talking about a little bit, it really depends. I mean, if you know you're going to be in the same tax bracket this year and next year, we don't have a new tax bill next year. We know the tax. Sometimes we know, okay, well, bonus depreciation's 100% this year versus 80%. Well, we know we now have permanency for the next 4 years. Really comes down to if you're in a higher tax bracket in 2025 than you think you're going to be in 2026, that's where the benefit would be, no doubt about it. Or, if there was some other event like you talked about with this game, which would put you in a higher tax bracket, but that's the main thing. If you know you're going to be in the same tax bracket in 2025, 2026, just kind of let the market play out, right? That's what I would say. Just the timing.
And it's interesting because when we always hear everybody says, hey, buy a property before the end of the year, buy a property before the end of the year. Really, you should be buying a property before the end of the year because you should be buying a property.
The investment piece of it, right?
That's why your CPA is telling you to buy a property. It's to buy the property because it's
the first and foremost,
and then sit on it and hold it and all those good things, but there are some additional components that may or may not kind of hold water for that specific year. This year, we kind of have the tax brackets the same. We have a little bit of consistency for at least the next 4 years. I used to think that closing costs were something that you could write off. And so I thought at the end of the year, you should close before the end of the year to write off your closing costs. Right before the show, you said, no, that's not the case. Those are capitalized.
That's right.
So that's not it. But I guess you could also state, hey, listen, if you close before the end of the year, you're going to have some depreciation for that year, and that might offset some other gains for yourself. And at least you would get that tax savings from what happened in 2025 versus waiting a year to get those tax savings. And additional tax savings earlier is always a good thing. So at the end of the day, you should be buying because it's a great idea to buy real estate and hold on to it for all the tax savings that are coming your way down the line. Is there a huge advantage to buy December 31st versus January 1st? It's probably a little overstated in the world out there. It's not.
All these questions. We got 8 questions. I think some of these have short answers. If we can keep it brief, let's keep it brief. Gordon Butler asks, does JWB break out the items that qualify for bonus depreciation on a property sold by JWB? That sounded like a yes, right? GC, like the JWB team will send you the things that are these like land improvements or things like that.
Yeah, I'm sure we can. It's
I've
not
seen
something.
reports.
Yeah, I'm sure it's pretty easy for us to do. We'll help any way that we can. This is all a little bit new for me. I'm not sure what our standard process is, but give us a call or reach out to your portfolio manager. We'll help as much as we can.
There you go. Laura Colby asks, hello, Bryan. I purchased a new construction property with JWB this year, but my portfolio manager was not able to send me an itemized list of the non-structural components. Can I estimate those costs when using software to do a cost seg report? I have real estate professional status and would like to take advantage of bonus depreciation this year. Thank you.
Yes. Be careful with estimates. If you estimate, make sure you document your estimate. Like some people like estimate mileage and stuff like that. You can make sure you document where you came from. And it's not just like, oh, I just completely came up with it, right? If you are, make sure you document it. And I would estimate conservatively. So if you do get audited, you can say, hey, here's where I got my number from. So
awesome. All right. Hall of Fame first baseman Jim Kirko says, Is there any depreciation play that can be used if you're buying and holding in your retirement accounts? Is this applicable for folks buying properties in their retirement accounts?
Yeah, I mean, the same rules hold, but if it's like a tax deferred account, a 401k, I I don't see the need to go do a cost segregation study. I mean, you've made the decision that real estate is the asset class for you. Just it's more of an asset class thing to me.
Yeah, I always, whenever I get this question, I always let people know that the reason that you love depreciation so much and bonus depreciation and all of this is to get to a place where you get to tax deferred status. That's really what you're trying to create. You use depreciation to do that. Well, if you're in your retirement accounts, you're already in that tax deferred status. So that's why it generally would not make sense to do a cost seg study because you're spending money on something where you already are at the finish line that you want to get to.
Right.
Excellent. Jerry Krishman asks, is bonus depreciation available for rental properties in the second year of life or just in the year of purchase, like manufacturing equipment? Mark Norman has a very similar question of, is it retroactive? Are we only able to do this bonus stuff if it's the year that you purchase it? Or like, let's say I've owned this property for some time. Now I can do bonus depreciation. I can like bonus depreciate the rest of it.
Yeah, so two answers there. It is in the year of purchase. So if you purchase, that's when you would take the bonus depreciation. If you failed to take bonus depreciation, let's say 2 years from now, you had bought 4 rental properties in November of 2025 and you failed to take the bonus depreciation, you can do a retro bonus depreciation calculation. You definitely would need a really qualified cost seg group, and there would be an accounting methodology change. So it's very technical, but it can be done. But generally, the bonus depreciation is just in the year that you acquire it.
And just to clarify, because I believe Jerry purchased the properties that Jerry's talking about in 2024. If he bought them in 2024, it would not apply, correct?
Well, it would only qualify based on the rules in 2024. So the bonus depreciation in 2024 was 60%. So if you had $50,000 worth of eligible assets, 60% of that would be subject to the bonus depreciation. Yep.
Got it. So you can take bonus depreciation based on like, was bonus depreciation in effect that year
And what
and
the tax
at,
law
at that
was.
level?
Yep.
Could you just do it by estimating and avoid the cost seg study if you're trying to do retroactive?
No, I definitely wouldn't. Yeah,
No.
because you have to go through and fill out a form 3115. You got to attach a bunch of stuff to your return. So if you're doing that, chances are an agent's actually going to be putting their eyes on the
Gotcha.
return. Yep.
Gotcha.
Got it. All right. Mike Foster, regular guy with extraordinary questions, asks what types of property expenses qualify for bonus depreciation? Sounded like these land improvements, sounded like anything that you're doing to the property proper, right? Like I might be needing to put a new roof on a property that qualifies, that type of stuff.
Roof doesn't, unfortunately.
Oh,
Yeah.
okay.
Yeah. Roof does for some commercial stuff, but generally a roof and like an AC unit, those are two that we get a lot and they don't qualify for bonus depreciation. But like your furniture, fixtures, land improvements, appliances, technology systems, those are the ones that we see very frequently. Some cabinets, depending, there's some exposure there. Some flooring, like wood flooring, and like if it's got some glue to it, some of that stuff.
Interesting. Is there like a rule based, like what is the thinking around kind of like this but not that? Is there anything to that?
That's it's politics. So we won't go there because that's who comes up with these rules.
So the lobby group for glue and flooring is really who's winning here. All right, I got you. All right. So we got an anonymous attendee asking, if a person had a real estate license and let it lapse, can they still qualify as a real estate professional or do they need to get a new license?
Well, I mean, to be clear, you don't have to have a real estate license to be a real estate professional. It comes.
I'm not a licensed real estate professional,
but you've been a real estate professional for tax purposes
for many years.
But it helps your case, especially if you have a full-time job. Again, going back to the CPA example, if you're a CPA, let's say you're a CPA later in your career, right? And you say, hey, I'm going to start doing real estate on the side. You don't have to be a real estate professional, but in working a lot of IRS audits, they're box checkers. So if you tell them I'm a real estate professional and you don't have a lot of other real estate businesses, they're going to say, well, this doesn't make sense. If you have that, yes, I'm a real estate, I have my real estate license. Even if it's lapsed, I think it helps your case. It doesn't hurt. It definitely helps your case.
Got it. Okay. A couple of questions here from Lee Bishop, the MVP. He asks, you talked about tax benefits for rental income properties, but are there benefits available for the primary residence as well? Does any of this bonus depreciation stuff affect primary residence or any of that stuff?
No, I mean, the thing with the primary residence, which is kind of down, is the SALT deduction. The caps went from 10,000 to something higher than that, 40,000. So that's on your primary residence. But the bonus depreciation, you generally don't take depreciation on your primary residence.
All right, we're going to that SALT deduction next. Last question by Lee. Can we write off closing costs on rental income properties if the property was purchased with retirement money?
No, I mean, generally your closing costs are always capitalizing the property. But again, if you own a rental property in a retirement plan, I see no reason to get aggressive and, expedite your deductions. I would just be very clean and simple and let it play out with straight line. So,
okay. All right. Good stuff, guys. All right. Let's move into some of the temporary changes in this tax code. I look, high level here. I see tip income exclusion. I see overtime pay exclusion. I see SALT deduction and auto interest deduction. Let's start with that SALT deduction because it just came up. Can you explain that, Bryan? What is this SALT deduction?
Yeah. So the SALT deduction was one that, even if you're not a tax nerd like me, you probably read about it at some point or heard about it on social media. It was just this big sticking point between the politicians. So historically, property taxes are deductible, right? In 2017, those property taxes, if you had a primary residence and you paid $20,000 in property taxes, the 2017 tax bill said you can only deduct 10,000 of that. And that's including state income taxes too. So these states where they had state income tax, I mean, it was this huge uproar, right?
Man, I didn't know that.
But in Florida, I mean, property taxes have really gone up, so it was a big number. So now the rule is $40,000 of state SALT is state and local taxes, right? So your primary residence, if you have $18,000 worth of property taxes, it's subject to, like with anything, it's subject to some phase outs, but you can now deduct $40,000. The phase outs are around $500,000. So if you make $500,000 of income, you're kind of underneath the old 10,000 rule. But if you're at 350 and you have $15,000 worth of property tax, well, you're gonna feel that. You're gonna get more deductions this year on your tax return than you did in the past.
Gotcha. Yeah. So I'm trying to think from the lens of a rental property, from like a JWB rental property owner. This really isn't going to affect you in your tax bill for your rental property at all.
No, I guess if you do out-of-state investors, I mean, if you have out-of-state investors and they're paying state and local taxes
where they live,
that's right,
on their primary.
That's exactly.
Oh, this is only primary. Is SALT only primary?
Well, it's primary because that's where it was, but it's also like your state income tax. So if you had one of your investors was in California, I think I saw that. So this individual might have state and local taxes.
Yeah.
So that 40,000 cap includes that. Let's say this person had 10,000 property taxes and $15,000 of state income tax. That state income tax is now tax deductible.
Gotcha.
So
it's and even if you're a primary homeowner in Jacksonville, it's hard to have $40,000 of state and property taxes.
Yeah, I mean, you got to have you got to have a pretty high end property.
So this is going to help those, because a lot of our clients live in California and the Pacific Northwest and Virginia and some of these really highly taxed areas. You guys are in for a treat there. Your property taxes and your state taxes will be not as much. And then you could just move to Florida and then you don't have any state taxes too. So there's also a solution.
And maybe not property taxes. Right?
And maybe not property taxes.
I like it. So, all right, good. Finally, we put it to rest. I was wondering what the SALT stuff was, state and local taxes. That by itself makes me more interesting in any room. Quick question on the auto interest deduction. Can you explain what's going on there?
Ooh, it's tough. I mean, historically, auto interest has never been tax deductible, right? And the politicians every year keep saying they're going to make things more simple. Well, all they do is just, it makes things more complex. Well, now there's a separate form that if you have interest on a personal vehicle, the interest can be tax deductible. And there's phase outs like with anything. And so there's phase out if your income is between 150 and 250. So if you make $260,000 worth of income, not going to benefit you. But if you make 100,000 and you have a vehicle with interest, now again, there's There's more rules. The property has to be required and assembled in the United States. So there's all types of rules. I put it in there because it is a hot topic that we're reading about. And I guarantee you when we're filing tax returns, we're going to get this over and over and over. So the first, if you make over 250, it's not going to qualify.
Gotcha.
But then if you make under, you then got to figure out, okay, will this qualify? I've heard like mortgage interest, your bank gives you a form 1098. Supposedly the auto interest companies like Ally Bank, some of these are going to be issuing some form that will help you with this calculation. So
interesting. I am in the market for a new car this year, so I'm very interested in this. Do you see you were going to say something there?
I was just going to say it makes sense for them to make it easy on us to drive demand, to buy more cars. So you got to think somewhere along the lines, they'll try to make it easy to understand what the interest deduction would be.
Okay. Before we move into the segment of the show I like to call cocktail conversation kingmaker time, I want to go back to QBI. GC, I know that you had some like really disqualified small business deductions. I know there's some nuance in there. Bryan, can you explain that real quick and just kind of give us the difference between is this something that applies to like a business like JWB that's like a small medium-sized business? Is it something that applies for somebody like me that has a really small business, or is this applied to real estate investors with a W-2?
Yeah, good question. So QBI is the qualified business income. That's what QBI is, and it's a deduction, right? And so this was enacted in 2017. In my 20 years of practice, might have been the biggest deduction that really doesn't get a lot of play.
Yeah.
It was almost not around this year because it was set to expire.
Gotcha.
So with this tax bill, it put it back in play. And so basically what it was, as I understand the bill, it was designed to try to spur manufacturing. Well, the accountants and the lawyers then say, well, this qualifies. And it basically qualifies for any business income other than CPAs, lawyers, accountants, and architects, right? So our business income does not qualify for this, but a real estate sales company, like if you're just generating commissions, land developer, those types of businesses qualify. JWB qualifies, right?
Yeah.
There are some limits. So they look at 20 it has to be a pass-through business. So like a C Corp does not qualify. Most businesses are pass-through. The net income that passes through. So if your net income is $500,000, 20% of that completely excluded from tax. It's a big number, right?
Yeah.
Completely.
A huge number.
Permanent. Yeah, permanent.
Every
single year.
I didn't even know it, but this is the beauty of the show.
Yeah.
Because as I was preparing for the show, I'm like, wait, tell me about QBI again?
It's huge.
I fired questions.
This is huge for me.
Yeah. Right. Like I did the math for us. That's hundreds of thousands of dollars of tax savings for JWB that I didn't even, I think it's because of the name of it. They call it QBI or qualified business income. It's not nearly as sexy as bonus depreciation, right? I think that's it.
Well, then there are limits. So it's limited to 50% of wages. So if you had like a software company that didn't really have any employees, it's kicking off a lot of profits. Well, they're limited to 20% of the net business income or 50% of wages. So you do have to have employees. If you had a bunch of rental properties, it's kind of fighting against the bonus depreciation a little bit. If you had 50 rental properties and you didn't have a lot of depreciation anymore, and these things are kicking off $200,000 worth of net business income, that's qualified business income. You don't have wages with those rental properties, so then you're like, well, it won't qualify. The other limitation is 2.5% of the adjusted basis of the property. So then if it's like $200,000 worth of net rental income, 20% of that, or the lesser of 2.5% of your adjusted basis. So we do see that the 2.5% with a lot of our large real estate companies have that wage base because they own a lot of properties.
Yeah.
So
I mean, that could be
huge
hundreds or thousands of dollars of additional QBI if you're just a rental property investor.
Yeah, absolutely.
Right? Especially if you own properties in cash.
Yeah.
If you don't have financing on it, that might be something to look into as far as how QBI can get even more tax savings than we already get.
Yeah. Yep.
Love that. Okay, let's move into cocktail party talk, guys. I think if you are at the cocktail parties that Greg likes to frequent, where everybody's talking about taxes, I think the hot topic at these hot parties is this idea of Florida proposing no property taxes, this idea of Florida abolishing sales on commercial rents, right? Like, Bryan, what's your take on kind of like these kinds of proposals, and I don't know, the feasibility of it, what you think the repercussions could be from your vantage point?
Well, the commercial rents is now law. So that actually went into law maybe 2 months ago. So now if you have, again, a CPA firm and you own the building, you don't have to pay sales tax on the commercial rents. So that's a big number. So you talk about trying to attract businesses into the state. That is a game changer, right? If you're in another state and you're thinking of, okay, where do I want to relocate? Well, you start performing your numbers and it's 7% lower here on rents. That's a giant number.
Gosh, yeah.
You know?
Each year.
Yeah.
I didn't even
Yeah.
really think through that.
Yeah.
Yeah.
It's giant. And so it was reduced last year to like 4%. So they had been talking about this. And so it's now, it doesn't exist. You know, so that,
We own our own building.
Yeah, you
so
don't-
we just say
that's exactly
7% of whatever.
and just the
we're paying rent.
administration of it too.
Yeah.
It's such a mess. So that's gone. The next one that I'm really interested in is this property taxes.
Yeah.
You know, property taxes. I mean, our the our governor is really trying to get people to continue to move here. Clearly,
Hey, Bryan,
right?
before we jump into there, I just want to key in on what we just said, right? Like, we are already in Jacksonville, the number one relocation destination for corporate relocations. The aha moment that Greg just had of like what this means every single year, 7%, right? Like this, like lower burden. That feels like a major number for anybody that's looking at a corporate relocation, going on these trends, right? Like building a new headquarter and or just like looking for a place to move as an attractive thing to Florida in general. And then, I would have to think that Jacksonville, with the cost of living and all these kinds of things, like, right, this could be like a major magnifier of these reports of Jacksonville being in the top 2 hottest job market based on the Wall Street Journal. Could take us to 1, or it could just continue this lead of being the number 1 corporate relocation. That's what we're theorizing, right?
Perfect. And you hit it perfect. I mean, if you're if you were the CFO of one of these companies and that 7% number was in your pro forma, take it out. That's just right across the board. That's cash in these companies' pockets. No doubt about it. So
What does that mean as a rental property investor, GC, when you hear that?
That means demand. That means population growth. If you look at which markets appreciate the most, it should make sense that the markets that have the most home price appreciation and the most rent price appreciation are also correlated to the ones that have the most population growth. So all of these things that make Florida attractive for people to want to move here, which a significant thing is the structure of our taxes in our state. All of these things are big components as why we have such high population growth. Over the last 10 years, I was just looking at the stats as I was speaking yesterday on a certain platform, and we have 21% population growth in Jacksonville over the last 10 years. The US average over the last 10 years, 5.6%. So that entire package is driving population growth. You want to be owning hard assets like rental properties in places where people are moving to. And that's why, those who invest in Jacksonville.
I'd love to see the inflation numbers in Jacksonville as compared, because we feel it, right? But it's good for people that own real estate, right?
Yeah.
Because I'm a business owner too. We hire people. Our main office is in Ponte Vedra, so we hire people in Jacksonville and we hire people in Gainesville. 2 very, very, very challenging markets to find people, right?
Yep.
And so the numbers you read on, all these media outlets of the job market's not any good, that's not the case in Jacksonville. That is not the case at all. So
it's interesting because,
go ahead.
Well, I'll just say, inflation. I think when we hear inflation, our first thought is, oh, I hate inflation, right? But, a big part of inflation is wage growth. We all want wages to grow, so there's, obviously inflation has been too high across the country. You're really looking for that place where you have low cost of living, high wage growth. And that's, obviously what we have here in Jacksonville.
Yeah. And I see this feels like business decisions that's like a lot of leverage, right? Like one business decides to relocate here, that's a whole bunch of new jobs, that's a whole bunch of like new offers, right? That'll push up wages. And it feels like a beautiful piece of the flywheel. You were about to go into this idea of no property taxes, Bryan, which feels more like a personal, should I just move there kind of thing, right? You want to talk about that a little bit?
Yeah, and it's not clear what they're going to do here. Is it only going to be property taxes for your primary residence? Is it going to be for investors?
Oh, I looked into that.
Yeah.
I saw it pretty clear. They said that it wasn't going to be for investors. Are you seeing different?
That's what I've heard, that it's
Yeah.
only for primary residents,
Okay.
but I don't know. And then is it going to be
Give me a heart
just
attack.
like an increase on like your exemption? You know,
Yeah.
I don't know. But what I do know is, again, if you're looking to relocate somewhere and you can buy this house here or this house here, and one of them doesn't have property taxes, that's a complete game changer for people, because we just deal with people, and we have been for years, people moving to this market. I mean, prior to the pandemic, we were seeing just tons and tons and tons of people come in. The pandemic just is crazy, because they call CPAs, right? They need a new CPA. They move from somewhere else and they call us, right? And so if this would be an absolute game changer for Jacksonville and the state of
It would
Florida.
probably be the biggest driver of population growth for the state of Florida. I don't know.
Yeah.
Ever? Maybe, I don't know.
Yeah.
I mean, I don't know how. It would be a game changer. To me, you got to figure out how you're going to pay for it, because the services that are so essential, like schools and the people who keep us safe in our communities, a lot of those funds are created by property taxes.
Yep.
So I haven't heard how we're going to pay for it, which gives me some pause.
Yep.
But if we go into the place where we can pay for it and it's equitable as far as how we can pay for it, oh my goodness. Everybody who owns hard assets, who owns rental properties, this would drive your home price appreciation through the roof. Your rents would go up. Your job base would go up. Median incomes would go up in the state. So if you could get to the place where we could understand how we would pay for it, not having property taxes is a big if. But if you got there, this would dramatically increase our collective returns on investment as rental property owners.
Yeah, I don't know. I'm just a tax guy. So I don't know how I don't know how all the political stuff works, but
Yeah.
I'm with you. It's part of the cocktail that is very interesting to talk about, but until it's law, it's just something to talk about, you know?
Yeah. I find it very interesting. I find really interesting the discussion that we were just having before the show about how there's these other states that we think of as these giant drivers of the economy, and these places where real estate prices have just become, have continued to go up for what seemingly is like forever. And you don't really associate Florida with those things, right? You mostly associate Florida with, yeah, sure, it's like a retirement place. There's some hospitality stuff going on, but a real driver of economic value for people that move here. It feels like there's a cocktail of things that are happening on the that are aided by tax incentives and some long-term trends of everything that's happening, right? The world becoming more virtual, people wanting to live in warmer climates. Now you add these tax incentives that have always been here that seem to be working really well for us and getting supercharged. That feels like Florida could become this new big player that's spoken about, kind of like these other bigger states where you're like, oh, this is the sixth biggest economy in the world, and it's just a state. Florida feels like it's making a real push at attracting technology companies, attracting healthcare, attracting logistics, and like life sciences and all these kind of like different investments that is being aided on the public-private sector to really drive this it's good to own in Florida kind of piece, right? Is that kind of like what you were saying, right, Bryan, in a certain way before?
Yeah, absolutely. I mean, because again, we talk to clients these clients would move from these other states and they would sell these homes. And you're like, man, some 1,800 square foot home for like $3 million. Yeah. You're like, this is crazy, but it's sheer people, right?
Yeah.
Supply and demand. It's just the old school supply and demand. If there's just so many people moving into an area, there's just going to be demand for this stuff, and it just pushes stuff up.
And the biggest thing is that some of these ideas I think are great. Some still have some work to be done, but imagine none of that happens.
Yeah.
We still have, 4 to 5 times the rate of population growth here. Like the value, people flock to value. They go to value. And for many people's minds, moving to the state of Florida is a really good thing, as evidenced by how many people are moving here and how population is growing. And again, you want to own the things that are in high demand. Population growth is correlated to home price appreciation. Big bedrock of why we love this asset class so much.
And hard assets in a place where prices are going up, right? That's kind of something that we just said. Bryan, this is an hour, man. You killed it. We had over 80 people here to listen to your wisdom once again. I think Greg, you're not the only one that loves talking taxes, right? I feel like we're starting to grow a not your average approach to appreciating the tax conversation. Maybe people want an invite to these fancy tax cocktail parties that you guys seem to be attending. But I want to thank the community for showing up today. Really great questions. I love when we have specifically Bryan here because people get to ask these very practical questions that fit their situation. And it's just like a perfect kind of like combination of understanding real estate investing, getting some personalized advice to a certain extent, but also access to like an expert that, many of us don't get to have on our payroll or get to do it because of the type of folks that Bryan works with. So Bryan, really, really appreciate you making time to come back in again, man.
Yeah. Thanks for having me, for sure.
It's been
Yeah, go ahead, JC.
it's been quite a ride, man. I really appreciate it. We've known each other for, I don't know, almost 20 years now.
Yeah.
And a truly extremely important part of the JWB company here, Bryan and Pivot, and truly helping a ton of our clients. So thank you so much for being here.
Well, it's been fun to watch you guys grow too. So
yeah, and I know that you definitely, you generally don't work with like the average investor out there, Bryan, but what is the type of like clientele or the people or how do we reach out to you? Anything like that, promote your services?
yeah, so our website's pivotcpas.com, and we do work with all types of clients. Most of our clients own businesses. We do tax planning around their businesses. And we have clients that don't own businesses, and we just kind of quote what a fee would be. Pivotcpas.com. Check us out.
Pivotcpas.com. Check them out. Next week, we are going into a historical lesson. We're looking at how high prices are right now. And we're asking ourselves, is this the highest they've ever been? And what can we learn from, is it price that we should be looking at? Is it value that we should be looking at? And what do the lessons in history tell us about these moments where real estate seems to be at a very, very high price, and yet it's a really, really good opportunity to buy. So hope that you join us next week on Tuesday. From now till then, GC, any final pieces of advice?
Don't be average.